IRS warning. What if I told you that in 2026, the IRS already knows more about your money than you think? Your crypto trades, your PayPal transactions, your side income is no longer hidden. It's already reported. And if your tax return doesn't match what the system sees, you're not just at risk, you're automatically flagged. This is not the old IRS. This is a system powered by data, by automation, and by AI-driven risk detection, where one small mistake can trigger an audit. In this video, I'm going to break down the new crypto rules you cannot ignore and the 5 tax mistakes that are triggering audits right now, even for people who think they did everything right. Because here's the truth. It's not about how much money you make anymore. It's about how perfectly your numbers match across the entire system. So, if you're filing taxes this year, you need to see this. Let's get into it. The new Form 1099-DA Digital Assets. By April 3rd, 2026, crypto anonymity is officially over in the eyes of the IRS. What changed? For the first time, crypto exchanges like Coinbase, Kraken, and Binance.us are now legally required to send Form 1099-DA to both the user and the IRS. The impact: before, taxpayers could rely on memory or incomplete tracking when reporting crypto gains. Now, that's over. The IRS already has a record of every sale, every trade, every transaction you made. 1099K rule. Payment apps. This is the topic creating the most fear and confusion among workers and entrepreneurs. What changed? The reporting threshold for platforms like Venmo, PayPal, Zelle, and Cash App has been drastically reduced. Before, you were only reported if you made over $20,000 and had 200 transactions. Now, the IRS is monitoring business transactions at much lower levels, with a target threshold around $600. Here's where the confusion begins. Many people believe that if they receive money on Venmo, even for something like splitting a dinner, they'll automatically owe taxes. The era of the ERAs has no way of knowing is officially over in 2026. With the rollout of Form 1099-DA for digital assets and the strict monitoring of payment apps through Form 1099K, your tax return must now be a perfect mirror of what banks and platforms are reporting. If it doesn't match, the system will trigger an automatic alert. Main body: 5 red flags. This is where the high retention, high value content comes in. Red flag number 1, income mismatches. 1099-K. If you receive money through Venmo, Zelle, or Cash App and it doesn't match what you reported, the system will detect it automatically. Red flag number 2, excessive business deductions. Let's talk about the home office deduction. Done right, it's legitimate. Done wrong, it becomes a magnet for audits. Red flag number 3, the new 1099-DA crypto. With the new reporting rules, missing even a single Bitcoin transaction is no longer a minor oversight. It's now considered a serious compliance issue. Red flag number 4, filing status errors. One of the most common and most dangerous mistakes. Claiming head of household without actually qualifying. Here's the reality: the dependent rule. This is one of the areas where the IRS detects the most errors, but also where people try to manufacture larger refunds. A dependent is not just someone who lives with you. For the IRS in 2026, there are two categories of dependents, and each comes with very strict and very different rules. Qualifying child dependent rules. For a child to qualify as your dependent and unlock the $2,000 child tax credit, they must meet 5 strict tests. 1. Relationship test. The child must be your son or daughter, stepchild, brother or sister, or a direct descendant of any of them, such as a grandchild or even a niece or nephew in certain cases. 2. Age test. They must be under 17 years old at the end of the tax year. Exception: if they are a full-time student, they can be up to 24 years old. But here's the critical detail. They no longer qualify for the $2,000 credit. Instead, they may qualify only for the $500 other dependent credit. 3. Residency test. The child must live with you for more than half of the year, at least 6 months on one day. 4. Support test. The child must not provide more than half of their own financial support. Important clarification. This does not mean you must pay exactly 50%. It means the child cannot be self-supporting. 5. Joint return tests. The child cannot file a joint tax return with a spouse. Here's where many people get trapped, even if your child lives with you. If they are married and file jointly, even just to claim a refund, they may no longer qualify as your dependent. Sometimes this happens when they file just to get a refund, even when they technically have no real filing obligation. That's why this rule is one of the most overlooked and most dangerous areas in dependent claims. Qualifying relative. This rule applies to dependents who are not young children. For example, parents, a child over 24 who is not working, an uncle, aunt, or other relatives. These dependents typically qualify for the $500 credit, other dependent credit. Gross income test. The dependent cannot earn more than $5,200 US per year, adjusted for 2026. If they earn above this threshold, they immediately stop qualifying as your dependent. Sport test. This is stricter than for children. You must pay more than 50% of their total financial support, including food, housing, medical expertise, basic living costs, relationship or residency tests. The dependent must either be a direct relative, parents, grandparents, etc., or, if not related, they must live in your home for the entire 12 months of the year. Custody conflicts, the most common IRS battle. This is one of the most common real-world scenarios in the US. Divorced or separated parents, both trying to claim the same child. Tiebreaker rules. Both parents claim the same dependent. The IRS applies strict priority rules. 1. The parent and the child live with the longest during the year 2. If time is equal, then the parent with the higher AGI, adjusted gross income. Form 8332, critical document. This is extremely important. Form 8332 is the official document where the custodial parent releases the right to claim the child to the other parent. Without this form, the IRS will automatically reject one of the tax returns, even if both parents believe they are correct. What happens if the dependent has an ITIN? This is crucial for Latino audiences. Child tax credit, $2,000. The child must have a Social Security number, SSN. If the child only has an ITIN, they do not qualify for the $2,000 credit. Other dependent credit, $500. However, if the child has an ITIN, they may still qualify for the $500 credit or parent eligibility. Even if the parent has an ITIN, they can still claim children who have SSNs and potentially receive applicable credits under IRS rules. Many people believe that simply sending money to family members in other countries automatically allows them to claim them as dependents. In 2026, the rule is very clear. To qualify as your dependent, they generally must be residents of the United States, Canada, or Mexico. But here's the critical issue. The residency and support tests are extremely strict. Don't risk your entire tax return for a $500 credit if you cannot clearly prove eligibility. Red flag number 5, rounded numbers. If all your expenses conveniently end in .00, the IRS immediately flags it as a sign that the numbers may be fabricated or estimated. The solution: software versus CPA risk management decision. Choosing between tax software or a certified public accountant, CPA, is not just about cost. It is fundamentally a risk management decision. Here's the technical breakdown. Professional tax software: TurboTax, H&R Block, Free Tax USA. Tax software is ideal for about 80% of taxpayers whose financial situation is considered standard. How it works: instead of looking at a complex Form 1040 filled with numbers, the user is guided through a structured interview. Did you buy a home? Did you have children? Did you receive cryptocurrency income? Key advantages: mathematically precise calculations. The software eliminates human math errors, mistakes that the IRS can penalize. Instant e-filing allows electronic submission using AGI or PIN authentication directly to the IRS system. Error protection guarantees. Most professional platforms offer a precision guarantee. If the software makes a calculation error, they cover the penalty fees, not the tax itself, but the penalty risk. Who is it for? W-2 employees, individuals with simple investments, small side businesses with clean, organized records, CPA, certified public accountant. This is where the expert's clinical eye comes in. A CPA is not just someone who fills out forms. A CPA is a tax strategist. Why this matters: IRS representation. If the IRS sends a letter or starts an audit, the CPA can represent you directly. Tax software cannot walk into an IRS office on your behalf. Proactive strategy software looks backward. It reports what already happened. A CPA looks forward, building tax strategy for the next year. Complex financial situations: a CPA becomes essential when you have rental properties or businesses with employees or foreign investments, including assets in Mexico, or corporate structures like LLC or S-Corp. Using tax software is like taking an aspirin for a simple headache. Hiring a CPA is like going to a cardiologist when you know you have a serious heart condition, or in the danger of doing it yourself, or using ghost preparers. There are individuals who charge cheap fees to fill out tax forms, but refuse to sign the return. These are known as ghost preparers. Key risks: audit risk. Incorrect filings or fake deductions are now detected in seconds by the IRS's new AI systems, legal responsibility. In the United States, the taxpayer is 100% legally responsible for everything on their return, even if someone else prepared it. Expert warning: if someone promises you a too good to be true refund and refuses to sign your return as a paid preparer, run. That is one of the biggest red flags of tax fraud. How to decide which one to use. If your entire financial life fits inside a folder, a W-2, and a few receipts, then professional tax software is more than enough and is safe. But if you have a growing business, real estate properties, or a financial situation that keeps you up at night, then investing in a CPA pays for itself through penalties avoided and the money they can legally recover for you. Cost and strategy. Comparison: proper tax filing versus late/incorrect filing. What you've just seen is not theory. This is the new reality of the US tax system in 2026. The IRS is no longer relying on what you say you earned, reported, or deducted. It is now cross-checking everything automatically through banks, crypto exchanges, and payment platforms. And that means one simple truth: if your numbers don't match, the system will find it. So whether you're using tax software or a CPA, remember this: it's not about paying more taxes. It's about avoiding expensive mistakes that trigger audits, penalties, and stress. So let's be clear. In today's tax system, it's not just about how much you earn. It's about how accurately your entire financial story matches what the IRS already knows. If you rely on the wrong person, or worse, someone who won't even sign your return, you're not saving money. You're taking a risk that could cost you far more. And when it comes to choosing between software and a CPA, don't think of it as an expense. Think of it as protection. Now here's what most people don't realize. The biggest audit triggers are not what you think. And in the next video, I'm going to break down the exact mistakes that are getting people flagged in 2026, even when they believe they did everything right. If you're serious about protecting your money, make sure you don't miss it. Subscribe to the channel right now. Hit the like button so this reaches more people who need it. And share this with someone who's filing taxes this year, because one mistake can change everything. I'll see you in the next video.